The tectonic plates of Wall Street are shifting right now in February 2026, and to understand this movement, we have to look beyond the headlines and into the mechanics of capital flow. For nearly a decade, the investment narrative was dominated by a singular, monolithic theme: bigger is better. The rise of the Magnificent Seven, the digitization of the global economy, and the passive investing boom created a self-fulfilling prophecy where mega-cap technology stocks sucked the oxygen out of the room. This left the rest of the market, specifically the small-cap universe, to languish in obscurity. But the script has flipped. The great rotation that contrarian strategists whispered about in 2024 and 2025 is no longer a forecast. It is a market reality. The Russell 2000, the benchmark for American small-cap ingenuity, has awakened from its slumber, staging a rally that is confounding skeptics and rewarding the patient. This is not merely a technical bounce or a fleeting short squeeze. It is a fundamental realignment of capital, driven by a perfect storm of macroeconomic tailwinds, including the normalization of interest rates, a historic valuation disconnect, a domestic manufacturing supercycle, and a resurgence of M&A activity. To understand why small caps are rallying in 2026, we must first dissect the anatomy of the pain that preceded it. The period from 2022 to early 2024 was a crucible for small businesses. When the Federal Reserve embarked on its aggressive rate hiking cycle to combat inflation, it disproportionately punished smaller companies. The divergence lies in the balance sheet structure. Large-cap companies, like those in the S&P 500, often locked in low fixed rates on their debt for long durations during the easy money era. In contrast, the Russell 2000 is heavily exposed to floating rate debt. Approximately 40 to 45% of the debt held by Russell 2000 companies is floating, compared to less than 10% for the S&P 500. For years, every basis point hike by the Fed was a direct blow to the bottom line of a small manufacturer in Ohio or a biotech firm in Massachusetts. Interest turnover ate into margins, stifled capital expenditures, and terrified investors. Fast forward to today. The Federal Reserve, having achieved its soft landing, has been cutting rates since late 2025. The Fed funds rate has descended from its peak, and the yield curve has normalized. This acts as an instant tax cut. Just as rate hikes were an instant penalty, rate cuts act as an immediate stimulus for small caps. As borrowing costs fall, the interest expense line on the income statement shrinks, instantly boosting earnings per share. Many small caps faced a terrifying maturity wall in 2025. But the easing of rates allowed these companies to refinance debt at manageable levels rather than facing insolvency. The default wave that bears predicted never materialized in full force. Instead, we got a refinancing relief rally. Another macro factor fueling this rotation is the US dollar. The aggressive strength of the dollar in the early 2020s hurt US multinationals by making their exports expensive. However, the Russell 2000 is a domestically focused index. Nearly 80 to 90% of Russell 2000 revenue is generated within the United States. As the dollar stabilizes or weakens slightly due to lower rates, small caps are insulated from currency volatility, while simultaneously benefiting from a robust US consumer economy. Now, let's look at the numbers regarding the valuation disconnect. By mid-2025, the valuation gap between large and small stocks had reached extremes not seen since the dot-com bubble of 1999 and 2000. At the height of the AI frenzy, the S&P 500 traded at a forward price-to-earnings multiple of nearly 21 times, driven by the premium valuations of tech giants. Meanwhile, the Russell 2000, excluding unprofitable companies, traded at roughly 12 times forward earnings. This spread was statistically unsustainable because markets are mean-reverting machines. When the spread between large and small valuations widens to 2 standard deviations beyond the historical average, a snapback is inevitable. We are currently living through that snapback. Investors eventually realized that the Magnificent Seven were priced for perfection, while the Forgotten 2000 were priced for Armageddon. It became mathematically difficult for trillion-dollar tech companies to continue doubling their earnings at the same pace due to the law of large numbers. Conversely, small caps had a very low bar to clear. Any news that was not catastrophic was treated as good. When earnings actually started to grow in late 2025, the upside surprise sparked a violent repricing. The Russell 2000 is not a monolith. It is a diverse ecosystem, and the current rally is being powered by 3 specific engines. First is the renaissance of regional banks. Financials make up a significant weighting of the Russell 2000. The regional banking crisis of 2023 left deep scars on the sector, and for 2 years, these stocks were radioactive. However, the stabilization of the yield curve in 2026 has been a game changer. As the yield curve steepened, meaning long-term rates moved higher than short-term rates, the banking business model of borrowing short and lending long became profitable again. We have also seen a wave of mergers among smaller banks, creating stronger, better capitalized institutions. Investors are buying baskets of regional banks in anticipation of further deal-making. The second engine is the biotech revival. Biotechnology is the high beta heart of the small-cap world. These are long-duration assets, meaning companies that may not be profitable today but promise massive cash flows in the future. Biotech is inversely correlated to interest rates. When rates were 5%, the discount rate applied to future cash flows crushed valuations. With rates falling to 3.5% and below, the present value of those future cures has skyrocketed. Furthermore, major pharmaceutical companies, facing patent cliffs for their blockbuster drugs, are sitting on record piles of cash. They are aggressively acquiring beaten-down small-cap biotech firms to replenish their pipelines. The third engine is the industrial reshoring supercycle. Perhaps the most durable trend supporting small caps is the reindustrialization of America. Supply chain fragilities exposed during the 2020s led to a massive push for onshoring and nearshoring. Small-cap industrial machinery firms, construction companies, and logistics providers are the direct beneficiaries of the hundreds of billions of dollars pouring into new U.S. factories, chip plants, and green energy infrastructure. The lingering effects of the infrastructure bills and the One Big Beautiful Bill passed in mid-2025, which provided tax incentives for domestic service and manufacturing expansion, have begun to show up in the quarterly earnings of Russell 2000 industrial components. However, despite the euphoria, a prudent investor must acknowledge the structural flaw in the Russell 2000, the zombie menace. A zombie company is typically defined as a firm that cannot cover its interest payments with its operating profit for 3 consecutive years. Depending on the metric used, between 30 and 40% of the companies in the Russell 2000 are unprofitable. This is a stark contrast to the S&P 500, where profitability is a prerequisite for inclusion. In a passive index like the Russell 2000, tracked by ETFs like IWM, you are buying the good with the bad. You are buying the dynamic future blue chips, but you are also buying the dying retailers and the cash-burning tech concepts that will never turn a profit. In the early stages of a junk rally, even zombies rise. Lower rates give them a lifeline, allowing them to refinance and survive another day. This dash for trash can lead to massive short-term gains. However, long-term investors must be wary. As the cycle matures, the market will separate the wheat from the chaff. The companies that use this reprieve to fix their balance sheets will thrive. Those that merely delay the inevitable will eventually go to zero. This dichotomy has led to a surge in popularity for quality small-cap investing, strategies that filter the small-cap universe to exclude unprofitable firms. So how does an investor play this rotation? The playbook has evolved. It is no longer just about buying the dip on big tech. If you believe we are in the early innings of a broad economic expansion, a simple low-cost ETF tracking the Russell 2000 or the S&P SmallCap 600 is the most efficient way to capture the beta of the move. The S&P SmallCap 600, ticker IJR, is often preferred by fundamentalists because it has a profitability requirement for inclusion, naturally filtering out the zombies. Given the inefficiency of the small-cap market, where fewer analysts cover these stocks, active managers have a better chance of generating alpha. A skilled manager can navigate the minefield of zombie companies and identify the future mid-caps before they are discovered by the masses. History also shows that small-cap value is one of the highest-performing equity asset classes over the very long term. Funds that target small size plus low valuation plus high profitability have historically crushed the broad market. In the current environment, where value gaps are still wide, this factor tilt is particularly attractive. Additionally, we are entering a golden age of mergers and acquisitions. Private equity firms are sitting on record levels of dry powder or uninvested capital. With financing costs coming down, they are hunting in the Russell 2000. Investors are looking at sectors ripe for consolidation, specifically regional banks, energy services, and medical devices. Owning a basket of these stocks provides exposure to potential 30 to 50% acquisition premiums. As we look toward the remainder of 2026, the trajectory of the Russell 2000 will be determined by the Goldilocks narrative. The bull scenario is that the U.S. economy avoids recession, growing at a steady 2 to 2.5%, while inflation remains tamed near 2%. The Fed continues to cut rates to a neutral level around 3%. In this scenario, small caps could see a multi-year run of outperformance, reclaiming the lost decade of returns relative to large caps. Earnings growth for small caps is projected to outpace large caps in 2026, estimated at 15 to 20% growth versus 8 to 10% for the S&P 500. The bear scenario warns that inflation could reignite, forcing the Fed to pause cuts or hike again, or conversely, that the economy slows too much, slipping into a hard recession. Small caps are credit sensitive. If credit spreads blow out, the rally will collapse. However, as of February 2026, the data points to resilience. Jobless claims remain low, productivity is high thanks to AI adoption even at the small cap level, and corporate balance sheets are healthier than expected. To truly appreciate the rotation, one must understand the index itself. The Russell 2000 is often misunderstood as merely a volatility index. While it is more volatile than the S&P 500, its composition tells the story of the real American economy. The S&P 500 is increasingly a global technology index. As of late 2025, technology and communication services comprise nearly 40% of the S&P 500. The Russell 2000 is far more balanced and cyclical. Industrials make up about 17%, financials about 16%, healthcare about 15%, and technology about 14%. This composition explains why the rotation is happening now. When investors want to bet on the US economy rather than global AI dominance, they buy the Russell. When they want to bet on reflation in manufacturing, they buy the Russell. We witnessed a classic market phenomenon in January 2026, the January effect. Historically, small caps outperform in January as investors sell losers in December for tax purposes and buy them back in the new year. In 2026, this effect was turbocharged by a 13-session win streak in mid-January. This was not just tax loss harvesting, it was institutional rebalancing. Pension funds and endowments, realizing they were underweight small caps after the 2025 run-up, were forced to chase the rally, creating a liquidity loop that drove prices higher. Markets are driven by two forces, math and psychology. The math supports the Russell 2000, but the psychology is just as potent. For years, fear of missing out was concentrated in Nvidia, Microsoft, and Apple. But as those stocks stalled in late 2025, a new FOMO emerged. Investors saw their neighbors making 20% in a month on small-cap ETFs and started to ask if they were too exposed to big tech. This psychological shift is crucial for the longevity of the rally. A rotation requires a change in belief. The belief has shifted from small caps being dead money to small caps being the new alpha. Value investors who suffered through the 2010s and early 2020s are finally being vindicated. This attracts capital to smart beta and factor funds. The inflows into funds like Avantis US Small Cap Value and Dimensional US Small Cap in early 2026 have been record-breaking. This sticky money provides a floor for prices. The Russell 2000 rotation of 2026 will likely be studied by market historians as a classic example of mean reversion and cycle dynamics. It serves as a reminder that in investing, trees do not grow to the sky, and every dog has its day. For the astute investor, the rotation offers a chance to diversify away from the crowded trades of the past and participate in the broad-based renewal of the American corporate landscape. Whether through passive index funds or active stock picking, the small-cap universe is once again open for business. The giants are sleeping, the nimble are running. Welcome to the year of the small cap.